Welcome to the IFRS Technical Review course. Tonight, we are going to be covering financial instruments. For those who I've not met before, my name is Michael Levy. This course is being taught partially by Ira Walfish and partially by myself. Even though on your computer it will say Ira Walfish for all sessions, you can probably tell that I'm not Ira, I'm Michael Levy. Let's go over what we'd like to cover this evening with regard to financial instruments. Starting with IFRS, there are a number of standards that relate to financial instruments. Number one is IFRS 7, which deals with financial instrument disclosure. That I will not be covering this evening. Disclosure tends to not be tremendously important for the exam, so I don't encourage you to spend very much time on disclosure. Furthermore, I wouldn't be able to add very much value when it comes to disclosure. I would simply be reading to you. So again, if you're welcome to look at IFRS 7 on your own, but I strongly recommend you not spend much time on it. It does not tend to be very important on the exam. Now, I will be focusing on financial statement presentation based on IAS 32, and I will definitely be focusing on the new IFRS, IFRS 9, which deals primarily with the measurement of financial instruments. Many of you would have learned IAS 39 in university, or some of you come from other countries, you may have learned that in your country of origin. The bottom line is that the rules in IFRS 9 replace those that existed in IAS 39 effective January 1st, 2018. So in real life, years beginning January 2018 is the first year IFRS 9 is being used, or at least being required to be used. And for exam purposes, it's also the first year in which IFRS 9 will be tested. Now, while there's a lot of guidance under IFRS, there's a much shorter and much more simplified financial instrument guidance under ASPE. ASPE just has one section that isn't that long called financial instruments. So most of the complexity is in IFRS rather than ASPE. I will be covering both this evening. Any questions before I get started? Venkat is asking, where do I find the material? The material can be found in the book. Again, some of you have a book, some of you have a binder. If you have a book, please turn to page 67 of the book. Unless you have an older version, it should be on page 67. If you're working from a binder, please go to the financial reporting section, and it should be the same page number within that section. The summary that I'm about to present to you is based on IFRS. I've summarized IAS 32 and IFRS 9 in a fair amount of detail, basically the level of detail that I think is important for the CFE. As I mentioned before, given that IFRS 7 only deals with disclosure, I have not summarized it and do not recommend you spend much time on it. There are some very significant differences between IFRS and ASPE, and I will highlight those differences as we go along in the lecture. So by the time we're finished this evening, you should know both IFRS and ASPE. I'd like to start with presentation, and then after presentation, we'll then move on to measurement. The following is a detailed summary of key aspects of IAS 32. As I go through this, I will compare IFRS with ASPE. IAS 32 deals with classification of financial instruments between liabilities and equity. Under what circumstances do I classify something as a liability versus equity? It also deals with situations where I'm allowed to offset an asset and a liability and just show the net amount. Under what circumstances do I need to show the asset growth and the liability growth versus under what situations can I simply net the two? So if I have an asset of $1 million and a liability of 600, under what circumstances can I just show a net of 400? Let's start with classification, which is what we'll spend most of our time on for IAS 32. The most important principle you've got to remember when you're dealing with classification, where financial instruments is concerned, is that classification is based on the substance of the instrument rather than its legal term. As long as something meets the definition of financial liability under the handbook section, we treat it as a financial liability even if legally it really is equity. And the reverse is also true. If something meets the definition of equity instrument, we treat it as equity even if legally it constitutes liability. So this is your proverbial example of substance over form. And the exact same thing is true under ASPE. So in this regard, ASPE and IFRS are very similar, although there are some differences I'll point out in just a moment. So I'm not going to go over this definition of financial liability, but the reason I put up this slide is when we try to figure out whether something is a liability or not, we're going to be coming back to this definition, and we'll be taking a look at whether that item meets the definition of liability. If it meets the definition you see here in front of you, we will treat it as a liability regardless of its legal form. Equity, this is the definition of equity. Equity is any contract that evidences a residual interest in the assets of an entity after deducting all the liabilities. Once again, if anything meets this definition, we will treat it as equity regardless of its legal form. Obviously, the most common examples of equity would be your common share, your standard perpetual preferred share. Those would be classic examples of equity. This definition of equity is the same under ASPE. What I'd like to do now is give you some examples of items where, for legal purposes, they're equity, but because they meet the definition of liability, we treat them as a liability. One very classic example that could come up, I don't believe this has come up yet on the CFE, but it did come up on the legacy exam, is a preferred share that provides for mandatory redemption by the issuer for a fixed or determinable amount at a fixed or determinable date. So an example of a mandatorily redeemable share would be, I go out and I issue shares, and I'm required to redeem them on a particular date for X dollars. That would be a mandatorily redeemable share. A mandatorily redeemable share certainly meets the definition of a liability because when I issue that mandatorily redeemable share, I've entered into a contractual obligation to deliver whatever the amount is that I need to pay to redeem the shares on a particular date. So I may issue mandatorily redeemable shares that I must redeem in 5 years from now for X dollars. I have a contractual obligation to deliver those X dollars and redeem the shares on that particular date. That meets the definition of a liability. Another example of something that's equity for legal purposes, but still a liability for accounting purposes, would be a preferred share which gives the holder the right to redeem the share on or after a particular date for a fixed or determinable amount, otherwise known as retractable shares. With retractable shares, the owner of the shares has a right to come knocking on the company's door and force the company to redeem the shares. So in that situation, once again, it meets the definition of a liability, even though these retractable shares are legally equity. Because when I issue retractable shares, I have a contractual obligation to deliver cash to redeem the shares when the owner of the shares comes knocking on my door and asks me to redeem them. So they're clearly a liability. The only question is, are they a current liability or non-current liability? And that'll depend on the terms of the shares. If the owner of the share can come knocking on the company door starting tomorrow, not only is it a liability, but it's a current liability. It's very similar to a demand loan, where the bank can demand payment anytime. On the other hand, if the owner of the share has to wait at least a year, then it would be non-current. Another example of an equity instrument that we would treat as a liability is a puttable instrument. A puttable instrument is very similar to your retractable share. The owner of the share can put the shares back to the company and force the company to pay them out. So similar to the case of retractable shares, if the holder of the puttable share puts the shares to the company has to pay the person out, or the company out, whoever's holding those shares, and therefore, given that there's a contractual obligation to pay out the cash, once again, we've got a liability. Now, it's important to note that the income statement always follows the balance sheet. So say we have an instrument which is legally equity, say mandatorily redeemable shares. We just said that would be treated as equity. Once we classify those mandatorily redeemable shares as equity, as a liability, once we treat those mandatorily redeemable shares as a liability, then we also treat it as a liability for income statement purposes. So rather than having the dividends go through retained earnings, the dividends are classified as interest and they go right through the income statement rather than going through retained earnings. because once we decide those mandatorily redeemable shares are for accounting purposes a liability, the dividends are then treated like interest expense. Furthermore, any gain or loss on redemption is not treated as a capital transaction, which is normally how you would deal with the redemption of redeemable shares, but rather it would be treated similar to a premium or discount on a bond. So at the end of the day, what I'm really trying to say to you is that once we treat something as a liability, we treat it as a liability in every respect. So at the end of the day, let's say I, for example, issued a mandatorily redeemable share. Say the mandatorily redeemable share was issued for, I don't know, $80 million. Okay? And say I commit to redeeming those shares in 5 years from now. It's very hard to write with this electronic. So for $85 million. Okay? So in this situation here, we treat this exactly the same way as if I would have issued debt for $80 million and agreed to repay $85 million in 5 years from now. Had we done that, we would have said you issued the debt at a discount of $5 million, and we would have amortized the discount and included it in interest expense. That's what we would have done for debt. We would do exactly the same for our mandatorily redeemable share. We treat it like debt in every respect. The only concession that the handbook is willing to make is that dividends classified as an expense may be presented either with interest on other liabilities or as a separate item. Let me explain. Let's say I've got real debt and I've got interest on my real debt per year of $1 million. And let's say I issue mandatorily redeemable shares or retractable shares, and I've got 500K of dividends on those shares that is being treated as interest because I have to treat these items as liability. The handbook gives me a choice of combining the two and just showing $1.5 million of interest, which would include my real interest in my real debt. The $1 million is the real interest on my real debt, along with my 500K of dividends that I'm calling interest. I can just combine the two together and just show $1.5 million of interest. Or if I want to, I can present my fake interest, my dividends on my mandatorily redeemable shares or retractable shares that I'm forced to call interest. I can show that separately if I want to from my real interest on my real debt. One final point that I'd like to make, just to avoid misunderstanding. It is only mandatorily redeemable shares that are treated as a liability. Regular redeemable shares are not treated as a liability. With regular redeemable shares, the company is not required to redeem the shares. If the exam just says ABC Inc. issued redeemable shares without the word mandatorily in front of the word redeemable, that means that the company can redeem the shares if they feel like it. With redeemable shares that are not mandatorily redeemable, that's not a liability because the company has no contractual obligation to redeem the shares. They can just redeem the shares if they feel like it. Now, there is an exception in the handbook where a puttable interest could be treated like equity rather than a liability. Normally, a puttable interest instrument, and I said earlier that's an instrument where the holder of the puttable instrument can force the company to pay them out. Normally, a puttable instrument would therefore be treated as a liability. But if all of these conditions are met, a puttable instrument would be treated as equity because if all these conditions are met, the puttable instrument is effectively functioning like common shares and therefore would be treated as equity. I don't think this is very likely to come up. I think it's quite unlikely to come up, and I would strongly recommend not memorizing this. In the unlikely situation that a puttable instrument came up and you were trying to decide whether to treat it as equity or as a liability, I would suggest you know where to find it in your handbook and just look it up on the spot in your exam. This is not the sort of thing that I would recommend you learn by heart. Number one, it's a lot of detail, and number two, not terribly likely. Now, I'd just like to point out a difference between IFRS and ASPE. ASPE also subscribes to the idea that an item can be equity and still be treated as a liability if it meets the definition of a liability. But ASPE has an escape clause that we don't have under IFRS. Basically, ASPE has an exception or an escape clause where an entity issues preferred shares in a tax planning arrangement. When an earlier version of the financial instrument section first came out under ASPE many, many years ago, it turned out that many instances of preferred shares that were issued for tax planning purposes, say in an estate freeze, for example, ended up meeting the definition of a liability. And the private enterprise world went wild because they said, all of a sudden now, we're going to have to start classifying also our preferred shares as a liability. The only reason we did it was for a tax planning arrangement. And once we classify these preferred shares as a liability, it'll throw off all our covenants and we'll be in a lot of trouble. So CPA Canada said, you know what, we'll make a compromise. Normally, you're going to have to follow the same rules as IFRS. If something meets the definition of a liability, even if it's equity, you must treat it as a liability. But we'll give you a break. If the preferred shares were issued in a tax planning arrangement, say an estate freeze, then you can present the shares in equity rather than as a liability in a separate line item within your equity section. And that way you can avoid, hopefully, breaching your covenants. Of course, you'd have to provide a suitable description explaining the terms. So for example, if they were mandatorily redeemable in the notes, you'd have to explain that, but at least you could treat the item as equity because it was issued in a tax planning arrangement. I see we have a question here. Let me take a look. Tanvir, I'd rather not go over the puttable instrument conditions only because they're very unlikely to come up. If you'd like to discuss them with me during the break, I'd be happy to. I have to conserve my class time to use it most efficiently, and this is something that's not very likely to come up. But again, just stick around during the break if you like, and I'd be happy to go over it with you. And that goes for anybody else who wants to stick around during the break. Let's continue. Okay, let's say I'm a private company and I issue mandatorily redeemable shares for an estate freeze. I would not be required to treat these shares as a liability. I can treat them as equity. However, what happens when redemption is demanded? What happens if I issue mandatorily redeemable shares? I'm using ASPE, I'm a private company, and then at year end, the holder of the shares demands redemption. At that point, even under ASPE, it wouldn't make any sense to allow the company to continue to treat those shares as equity. At that point, the shares would have to be reclassified as liabilities, and the liability would be measured based on the amount of money you need to pay to redeem the shares. Any adjustment due to remeasurement of the amount set up on your financial statements would go through retained earnings. Now again, I'm going to demonstrate this by way of example. But before I get to my example, I just want to make sure people understand. Initially, when we issue those redeemable shares, as long as they were in a tax planning arrangement, we can treat them as equity. It's only when redemption is demanded that we need to reclassify it as a liability. So let's take a look now at an example. Say a company issues mandatorily redeemable shares for tax planning purposes. They issue the shares for $1 million, and initially they're set up as equity because we're dealing with ASPE, but they're redeemable for $1.2 million. When it comes time to redeem the shares, we have to pay out $1.2 million, even though they were issued for $1 million. So let's take a look at what the entries would be under ASPE. The initial entry would be debit cash, credit equity, because we're working with ASPE. Until redemption is demanded, the shares would continue to sit in equity. Let's assume the following. Let's assume that at the end of year X, redemption is demanded. At that point, I have to reclassify the shares as a liability, and I have to set up the liability for the full amount I'm going to have to pay out, which is $1.2 million. So what would my entry be? I would debit equity in order to remove the shares from equity and reclassify it as a liability. But the amount I would set up as a liability would not be $1 million, but the full $1.2 million. The difference between the amount I initially set up as equity of $1 million and the $1.2 million I need to set up, because that's the redemption amount, that difference goes through retained earnings. That difference goes through retained earnings, so I would debit retained earnings $200,000. What would you name, when you say what should we name the liability at, the bottom line is, it doesn't say that you would necessarily have to classify it separately from other liabilities. So it would probably be included among other liabilities, but in the notes, you'd have to explain the nature of the liability. So again, you wouldn't on the body of the statements necessarily have to give it a specific description, but in the notes, you would certainly have to describe exactly what the terms are and what the nature of this liability is. So you'd have to, I'm assuming you're talking about when redemption is demanded. So once redemption is demanded, in my notes, I would explain these are redeemable shares, and I'd give them. Okay, contingent settlement provisions. Let me explain what this is all about. This relates to a situation where the manner of settlement depends on the occurrence or non-occurrence of uncertain future events or on the outcome of uncertain circumstances beyond the control of both the issuer and the holder. Let me explain. A contingent settlement provision would be where the company has to redeem the shares, they're mandatorily redeemable, but only if a particular condition transpires in the future, and it's completely beyond the control of both the issuer of the shares and the holder of the shares, whether this condition transpires, okay? I don't know, I only have to redeem the shares if the economy doesn't grow by X%. Or I only have to redeem the shares if interest rates go down by X% or go up by X%. That's beyond the control of the issuer and the holder. Under IFRS, the default would be to treat these shares as a liability unless one of these exceptions is met. The one that's important for you to remember is A, okay? I wouldn't worry as much about B and C. I'm not going to go over B and C. You can take a look at it on your own. Or I'll just very quickly mention B or C. B says basically the issuer can be required to settle only in the event of liquidation. So these are shares where I only would have to redeem if the condition takes place and the company liquidates. C says the instrument has all the features of a puttable instrument that would be required to classify it as equity. A few slides ago, I showed you 5 conditions, which I did not go over, that would have to be met to treat puttable shares as equity. We're saying if you met all those conditions, you wouldn't have to treat them as a liability. The one that I want to focus on is A. A says that you would not have to treat the shares as a liability, even though you'll be required to redeem them if a particular condition transpires, if that condition is highly unlikely to occur. If the settlement provision is not genuine, meaning that the condition is highly unlikely to occur, so it's highly unlikely that you would have to redeem the shares, we don't force you to treat them as a liability. So notice, guys, that under IFRS, unless it's highly unlikely the condition will take place, you have to treat the shares as a liability. Here is an area where ASPE is different. ASPE says, if a financial instrument labeled as a share gives the holder the option to require redemption upon the occurrence of a future event that is highly likely to occur, only then would you have to treat it as a liability. Notice that under ASPE, you would only have to treat these shares as a liability if it is highly likely that the condition will occur. So I hope that some of you have picked up on the huge difference between ASPE and IFRS. Notice that under ASPE, the default is equity, unless the condition is highly likely to occur. So unless the condition is highly likely to occur, we treat it as equity. This is very different from IFRS. With IFRS, the default is a liability unless the condition is highly unlikely to occur. So let's take the situation of where there's a 50-50 chance the condition will occur and I will have to redeem the shares. What would ASPE say? Treat it as equity or liability if there was a 50-50 chance of the event occurring? What would ASPE say? ASPE says that it's equity unless it's highly unlikely to occur. So excellent. ASPE would say it's not a liability. Okay, ASPE says you treat it as equity unless it's highly likely to occur, right? Highly likely to occur. So if there's only a 50-50 chance of the occurrence, then I would treat it as equity because I cannot say it's highly likely to occur. How about under IFRS? If there was a 50-50 chance of the condition transpiring, what would IFRS say, liability or equity? Excellent, very good, liability. A number of you are getting this right. The reason why I would say liability is IFRS says you got to treat it as liability unless it's very unlikely to occur. If there's a 50-50 chance it's going to occur, then I cannot say that it's highly unlikely to occur, and I have to treat it as a liability. So notice that IFRS is stricter here in terms of forcing you to treat something as a liability. Okay, compound financial instrument. If a financial instrument contains both a liability and equity component, it constitutes a compound instrument, and the components need to be classified separately. The most typical example, and probably the only example that could conceivably come up on an exam, and it has come up in the past, again, not on the CFE, but on the legacy exam, is a convertible bond. A convertible bond has both a liability and an equity component in it. Because what is a convertible bond? A convertible bond means that the holder of the bond has the right to convert the bond into the equity of the company, typically into common shares of the company. So when a company goes out and issues a convertible bond, in one fell swoop, they're really issuing two different things. They're issuing a liability, because if the holders of the bond want to be repaid, they won't convert, and the company will have to repay the bond. So it's a bona fide liability. But they're also issuing an equity instrument, because they're effectively issuing a call option on their own shares. When I issue a convertible bond, I am allowing the holders of the shares to purchase my shares based on the conversion price built into the convertible bond. The holder of the convertible bond can say, instead of holding on to the bond, I want to convert it into common shares based on a particular conversion price. So when I issue a convertible bond, again, don't worry if you don't understand the mechanics, they're not terribly important. Those of you who have a stronger finance background will probably understand this better. When I issue a convertible bond, I'm effectively issuing a call option on my own shares, allowing the holder of the bond to purchase my shares based on the conversion price built into the convertible bond. Issuing a call option on your own shares is effectively equity. So a convertible bond is really a combination of a liability and equity. And again, if you don't understand why, don't worry. It's not terribly important for the exam for the CFE you're going to be writing. Now, under IFRS, IFRS says when I issue a convertible bond, I need to allocate the value of the bond between liabilities and equity. Let's say I issue the bond for $1 million. Part of that $1 million will be treated as a liability. Part of it will be treated as equity. Now, how do I decide what portion of my bond is a liability? What portion is equity? The way you would typically do it is the equity component would be assigned the residual amount after deducting from the fair value of the instrument as a whole, the liability component. What you would typically do when you issue a convertible bond under IFRS for $1 million is you first try to figure out the liability component. Let's say the fair value of the liability component is $700,000. You'd plug the equity component as $300,000. If the liability component is $800,000, you'd plug the equity component at $200,000. Now, under ASPE, there are actually two acceptable methods for the initial measurement of the liability and equity elements. ASPE says we're going to give you a choice. If you want, you can do it the same way as under IFRS. Figure out the least easily measurable component after deducting from the total value of the compound instrument the other component. So typically the liability component is easier to figure out. Figure out the fair value of the liability and plug the equity component, just like IFRS. That's one option. But let's say you're a small private company and it's just too complicated to worry about breaking down the bond. ASPE gives you the option of allocating the entire proceeds to the liability component and assigning 0 to the equity component. So in my example, if you want to keep your bookkeeping simple, ASPE says that's fine. You can treat the whole liability you can treat the whole $1 million as a liability and have no equity component. Now, not every private company would want to choose this option. This first option is easier from an accounting perspective. It makes the accounting simple. But a lot of companies, even if they're private, might prefer the second option because they may prefer to allocate a portion of the liability to equity in order to have a stronger financial statement. Now, I am not going to go over the number crunching for how to break down the $1 million between equity, and liability. Because complex instruments such as convertible debt and derivatives are only examinable at the C level, for Core 1, and only at the B level for the assurance elected. So what does this mean for people writing the CFE? What it means is the following. On the CFE, they can only test this at the B level. And again, what they do in the competency map, which lays out what you need to know for the CFE, is they assign levels at which you need to know different topics. So when it comes to complex instruments like convertible debt, they only assign a C level, which is a very low level of knowledge, where quants is extremely unlikely to come up at the Core 1, for Core 1 level purposes. And for those doing the assurance elective, it's B level where quants could come up. Here's the however. When it comes to the CFE, other than on the comp, and other than those doing the assurance role on the comp, they can only test it at C level, because unless you've chosen assurance on your comp, basically you would only be tested at the C level. So on day 3, as well as even on day 2, for the common requirements that everybody needs to deal with, they can only test the subject at a C level, which means they wouldn't test it quantitatively. In theory, they could test it at the B level for those people doing assurance role, but it's highly unlikely, because generally on the comp, the financial accounting requirements are common to all writers, regardless of the role they've chosen. So they'd have to be very creative to come up with a situation where you were dealing with convertible debt, but only those people doing the assurance role. So it's not impossible, but it's unlikely. So given this situation, I am not going to go over the numbers. I've given them to you in the notes. I've given you a really good example. You're welcome to go through this example if you like. There is that tiny possibility that they could test it just under assurance in the roll comp. But again, they would then have to come up with an accounting issue just for the assurance people to deal with, which again is extremely unlikely. So again, if you want to cover all your bases, by all means, go through this, but I'm not going to spend class time on it. It's not a good use of time. Those of you who have not chosen the assurance role, it's I'd say it's even less likely you're going to deal with it, simply because it would only be examinable at the C level, and they're not going to test the nitty-gritty quants at the C level. Okay, so the main thing you want to know about convertible debt for the purpose of the exam is simply that it needs to be broken down between debt and equity. Number 2, I would remember that under IFRS, I first figure out the liability component and then plug the equity component. And then I would remember that under ASPE, I have a choice of breaking down the bond between liability and equity or showing the whole bond as a liability. That's the main thing I would remember about convertible bonds for the exam. The next thing I want to talk about very briefly is settlement in an entity's own equity instrument. What happens where an entity has the contractual right or obligation to receive or deliver a number of its own shares or other equity instruments? Let me explain what I'm dealing with here. What I'm dealing with here is the following situation. Let's say my company issues an obligation of $1 million, but the company either has the right or the obligation to settle that obligation by issuing its own shares rather than paying out cash. But here is an important point. The number of shares that the company will have to issue will vary depending upon the value of the shares. If the shares go up in value, the company will have to issue a lesser number of shares than if the shares go down in value. The company will simply have to issue enough shares to be equal to the amount of the obligation. And I'm going to show you an example in just a moment, but I seem to have a question. Let me take a look here. Mitra says, so whenever it's C level, we don't have to worry about quants. Mitra, I wouldn't say it's a hard and fast rule, but I would say that when you're dealing with accounting topics that are C level, it is extremely, extremely unlikely that they would test quants, because C level generally means you need a very, very general knowledge of the topic. Once you start to get into quants, it's being tested at a far higher level of detail than would normally be the case for C level. So although it's not a hard and fast rule, it's extremely unlikely you'd be doing quants for something at C level. Let's continue. I'd like to give an example of this situation here on the next page, and then I think you'll understand it. Let's say you have a company that has an obligation of $1 million. At the time they entered into the obligation, their stock price for their shares was $100. So had they been required to repay the obligation the second after they issued it, they would have had to issue 10,000 shares, because 10,000 shares times $100 per share equals $1 million. However, let's assume that the time of the required payment is 2 years from now. They have to repay it in 2 years. And they're going to be repaying it with shares of their own company. Let's assume the number of shares they will have to issue is variable. They will simply have to issue enough shares to equal $1 million. So for example, say in 2 years from now, the stock price is $200, they would only have to issue 5,000 shares, because 5,000 times $200 per share gives me $1 million. If the share price goes down to $50, the company would have to issue 20,000 shares, because 20,000 shares times $50 equals $1 million. So the number of shares they're going to have to issue is variable. It depends on the share price. The lower the share price, the greater the number of shares they would have to repay in order to equal $1 million. In this situation, we would treat the obligation as a liability rather than equity, because a variable number of shares will have to be issued. So as long as I don't have to issue a fixed number of shares, I just have to issue that number of shares that will equal $1 million, I treat this as a liability. However, let's say we've committed to delivering a fixed number of our own shares. Let's say at the time we entered into the obligation, we agreed to issue 10,000 shares no matter what the value of the shares in 2 years from now. We'll always issue 10,000 shares, that fixed number. In that situation, we would have to treat the obligation as equity. We would treat the obligation as equity. So all you have to remember is when a company either can or is obligated to repay an obligation by issuing their own shares, the only thing you have to ask yourself is, will a variable number of shares be issued? I.e., will they simply be issuing that number of shares that equals a liability? If the answer is yes, then it's a liability. If they commit to issuing X number of shares, regardless of what the share price will be in 2 years from now, then we treat it as equity. Treasury shares, I've got nothing to add to, so I'm going to ask you to look at it on your own. Financial instruments, as you know, is a very, very big section in my book. So I'd like to go over those slides where I think I can add the greatest value. If something is self-explanatory, I ask you to look at it on your own. I believe the treasury share portion is self-explanatory. Offsetting of financial assets and liabilities. I mentioned earlier that one of the topics dealt with in IAS 32 is under what circumstances am I allowed to take an asset and offset it against the liability and just show the net amount, rather than showing the asset on a gross basis and the liability on a gross basis. The basic rule is as follows. Offsetting is allowed when A, the entity has a legally enforceable right of set-off, and B, they intend to settle on a net basis or to realize the asset and liability simultaneously. The logic to this is that you're required to present financial assets and liabilities on a net basis when doing so reflects the entity's expected future cash flows from settling two or more financial instruments. If I'm going to settle them on a net basis, when the entity has a right to receive or pay a single net amount, and that's their intention, it's going to be settled on a net basis, then it only makes sense to show a net liability or a net asset rather than showing each on a gross basis. What I did in the remainder of the notes on this topic is I just gave you examples of what we mean by settling on a net basis. So please go over these examples. Again, I don't have anything to add to these examples, but they are important because the issue of whether I can net out assets and liabilities rather than showing them on a gross basis certainly could come up. So please go through the examples I provided. I'm just not going through them because I believe they are self-explanatory. This concludes the section of the course on financial instruments that deals with presentation. I will now be moving on to the subject of recognition and measurement, and that will be a separate video.